Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
A very good morning, ladies and gentlemen. I would like to welcome you all to the first BAI webinar after the long summer break. I hope all of you made it through the hot summer safe and sound and were able to enjoy a few days off before the year-end rally now starts over again. So my name is Philipp Bundenberg and I'm happy to welcome you to this BAI webinar, which we will host together today with our member firm Eris on European leveraged loans. And I'm very pleased to introduce three experts in the fields of leveraged loans. Please welcome with me Boris Okuliar, Brian Abdelhadi, and Elliot Hill. Boris is partner in the Eris Credit Group and portfolio manager and as well co-head of the Global Liquid Credit, member of the Eris Credit Group's European Liquid Credit and European Direct Lending Investment Committee, as well as member of the Global Asset Allocation Committee. Brian is partner and portfolio manager at Eris and also member of the European Liquid Credit Investment Committee, and Elliot is vice president at Eris and where he focuses on credit investor relations. So before we start over, just let me introduce the functions of the GoToWebinar toolbox. So if you're not familiar with GoToWebinar, on the upper right hand side, you should have the toolbox where you can ask questions anytime during our webinar, and after the presentation we will have a short Q&A session, and Elliot, Boris and Brian are happy to answer all your questions after the presentation. What's more, the webinar will be recorded, so feel free to rewatch the webinar or to forward the presentation, and of course also the records to your colleagues. So the presentation slides will be made available from after the webinar for download, and what's more, Roland is going to send you an email in the next few days with this presentation slides. So as I already said, this is our first webinar. Yeah, next slide, thanks. After our summer break, so there are lots of webinars following. On Wednesday, webinar on long volatility. Next week, we will have a webinar about impact of rising interest rates, the inflation and the effects on the real estate market. We will have more webinars in September about the SFDR RTS and the European ESG template, reporting for alternative investments. And in October, webinars on timber and the clean energy sector. But we can also meet in person next Monday in Frankfurt. I'm happy to see you all there. There's still a few tickets available for the BAI Innovations Day. It's our second Innovations Day. Last year it was online because of COVID. Now we are in person in Frankfurt, Campus West, and next Monday talking about new technologies in the asset management industry, especially DLT, AI and DeFi. So you should not miss this opportunity to meet colleagues, to meet friends, business partners, and our association next Monday in Frankfurt. So now, let's start with the presentation of Eris. I will hand over first to Elliot, and I wish you all success and an interesting webinar.
Okay, great. Well, thank you to everyone on the line for joining us today, and thank you to Philip and the rest of the BAI team for inviting us to present on your webinar. My name is Elliot Hill, and I form part of Ares Management's Global Liquid Credit team, where I specifically focus on the asset class we are here to talk about today, and that is, of course, European leveraged loans. Today's webinar is titled European Leveraged Loans, an Allocation That's Here to Stay. And this shares the name with a white paper that Boris, Brian and I wrote earlier in the year. Now, this white paper's aim was to really act as a sort of primer on the European leveraged loan market in order to help investors become more knowledgeable on a segment of the market that we think has really flown under the radars, particularly when you consider the attractive return profile that the asset class has produced. So we really hope that today's presentation achieves the same goal as our white paper and leaves you with a better understanding of an asset class that, in our opinion, should be considered as a core holding within an investor's broader portfolio. But before we dive into the agenda, I thought we'd briefly provide a bit of context around the organization that's presenting to you today. So moving to slide 5, we have an overview of Ares Management. So Ares Management is a truly global asset manager, as you can see on the top right of the slide, where we have offices really situated across pretty much every continent around the globe. We have over 2,000 employees, and in terms of assets under management, we have just under $350 billion, and that's as of the end of June. In terms of the products that we offer at Ares, we split these across 5 different segments, again, as you can see on the right-hand side, that being credit, private equity, real assets, which is split between real estate and infrastructure, secondaries within debt and equity, and then finally strategic initiatives, which includes our Asia business, our insurance business, and a SPAC. But the bulk of our AUM, as you can see, sits within credit. And this is really where Ares has a significant track record, over 20 years. And that's really managing credit assets across the spectrum. So from liquid tradable instruments in the public markets, all the way to more esoteric and illiquid parts of the market, such as private debt and asset-based lending. As we said at the top, we personally form part of the Ares Global Liquid Credit team, and that has around $40 billion in assets under management. And that's with an opportunity set that consists of high-yield bonds and, of course, leveraged loans. So moving to the next slide and kicking into today's agenda, you can see that we've split the presentation into 3 main topics. I'll be kicking us off with the first topic, the evolution and compelling performance of the European leveraged loan market. Boris will be picking up on the second section, so looking at the drivers of the compelling risk-adjusted return profile, specifically focusing on the strong and improving credit performance of the asset class. Brian will then go through the rate structure of the asset class, and then finish off by looking at some shifting market dynamics that we think investors should be aware of today. So without further ado, I will kick us off with the first section, the evolution and compelling performance of European leveraged loans. And when it comes to a primer, I think the very best place to start with any asset class is to just provide some context around the size and growth of the asset class over time. And we show that on the left-hand side of slide 8, where we show the growth in par outstanding of leveraged loans, European leveraged loans over time, which as of today sits at around 400 billion in euro terms. Now, this is off the back of substantial growth, where even over the past 10 years, the market has more than doubled in size. And as a result, we think European leveraged loans has become a distinct segment of the financial markets and can be considered as large enough to be a standalone allocation within an investor's portfolio. And that's as opposed to it being a sort of off-benchmark tactical exposure or an accent within a multi-asset strategy. The other theme we wanted to highlight on this slide is the increased liquidity we have seen in the market over time. And we've conveyed this on the right-hand side of the slide by showing quarterly trade volumes across a sample of 15 banks. Now, much like the growth in the asset class, the trading volumes have also grown substantially. And when it comes to managing loan portfolios, around 10 years ago, management styles would have been a little bit more different, perhaps a bit more buy maintain in nature. And that's due to the fact that most liquidity could be found in the primary markets, but while in secondary, it would not necessarily be that easy to source the assets that you want, and it could be expensive to make material rotations to your allocations. However, if you fast forward to the market today, larger managers like ourselves, we're able to trade in the hundreds of millions in a single day. So it really has become a market where managers are able to be more nimble and rotate portfolios in order to reflect their market views. So just turn into the next slide. And actually, the next few slides focus on the performance of the asset class. Now, there are many ways in which we can think about performance, But one of our favorite metrics is the Sharpe ratio, where total returns are divided by the volatility of returns to give you performance on a risk-adjusted basis. Now, as you can see on the right-hand side of slide 9, this is a metric where European loans really do stand out when compared to other asset classes such as equities, high yield, emerging market corporates, and investment grade corporates. A key driver of the stellar risk-adjusted return profile is the relatively low levels of volatility the asset class exhibits when compared to these competing markets. And you can see on the left-hand side, the loan asset classes are second only to the investment grade credit asset classes when we consider the average rolling volatility over the past 10 years. Now, there are several factors driving that low volatility dynamic, but we'll be going into those later on in the presentation. But why do we care about risk-adjusted returns so much? Well, a higher Sharpe ratio ultimately means a more stable and consistent return profile that gives investors a higher level of certainty that returns will meet expectations. Now, we can show these attributes of stability and consistency again on the next slide, where we consider calendar year returns over a long-term horizon. Now, on the left-hand side, we've looked back over the past 17 calendar years, so all the way back to 2005, and counted the number of positive and negative returning years, respectively. And when it comes to European leverage loans, the asset class has produced the highest number of positive calendar years over that period, and that's versus any other markets that you see in the table. So this means that when you invest in European loans over this period, you've rarely lost money regardless of the entry point that you have chosen. The only 2 down years to speak of are 2008, which is of course linked to the global financial crisis, and then also in 2011, when the asset class was only down 65 basis points. The final theme to show on the table is, as at the end of 2021, this marked 10 consecutive calendar years of positive total returns for European loans, which again is way ahead of any other markets that you see on the table. The final theme to point out on the slide is on the right-hand side, where the returns we have seen year to date are another good example of the lower volatility characteristics and resilience of the asset class. So you can see loans are only down 2 to 3%, and that's as at the end of August, so just a few days ago. Meanwhile, high yield, equity, and even investment grade credit have seen a significant downdraft year to date and are all down by more than 10%. Another data point that we show on the next slide that really underscores the downside protection that loans provide is the drawdown profile, i.e. we're measuring the cumulative return of an asset class once it falls below its high watermark. We show the drawdown profile of loans over the past 10 years on slide 11, and that's alongside high yield and investment grade. Now, despite my best efforts formatting this slide to make the chart clearer, with the European line in dark blue, to make things easier, we've added a table at the bottom showing the maximum drawdown experienced in the 5 most volatile years in the past decade. And apart from 2020, where the drawdown was similar across the leveraged credit markets, which was sort of around 20%, in all other years, European loans has consistently had the lowest drawdown. And that's even, again, when compared to investment grade rated markets. So, as you've probably gathered from these past 3 slides, the key attributes the asset class exhibits from a performance standpoint is stability and consistency. I think I've said those words a lot now. And there are multiple metrics that we can point to convey these themes, and again, really highlight the relative outperformance of the European loan market over a long-term horizon. But I appreciate the themes we've shown so far are slightly more backward-looking in nature, and as we know, past performance is no indication of future returns. So what characteristics does the asset class have in place that give us comfort that the attractive risk-adjusted return profile can be maintained? Well, on the next slide, one obvious metric to consider is the yield of the asset class. So on slide 12, we're showing the euro hedged yields across global credit markets, with the dark blue bars showing yields as of the end of June, where clearly European loans looks relatively attractive, given that they are over 1% higher than the next highest yielding market, and that being European high yield. However, given the volatility we've seen this year, it's perhaps a little bit more appropriate to look at the average yield over the past 5 years, and we've indicated that with the gold circles across the slide. The key takeaway here is that the European loans consistently provide a yield of 4% plus, which compares favorably to the high yield indices and is more than 8 times greater than the yields on offer within the IG space. So we think the asset class is well placed to keep delivering a return of around 4% plus, as it has consistently done so in the past. But what gives us comfort that the volatility of returns will remain relatively attractive? Well, a key factor is shown on slide 13, the next slide, where we have an estimated ownership composition of the asset class. The main thing to highlight here is that 99% of this pie chart is comprised of institutional investors. So for instance, over 50% of the market is owned by CLO vehicles, while the next largest investor type comes in the form of separately managed accounts and funds for investors such as insurance companies and pension funds. Now, this ownership composition has meant the asset class has a relatively low sensitivity to prevailing market sentiment, which has helped to characterize that stable return profile. Institutional investors tend to have a long-term investment horizon, meaning the asset class tends not to suffer from the short-term technical pressures that are often associated with retail outflows. And in addition to this, the large CLO contingent has a degree of pricing power. Now, as a result, there tends to be a floor on the margins that issuers can offer when pricing a new deal in primary markets, and then that floor will align with the CLO investors' return targets. I think 2021 is a good example here, where despite very strong market conditions and indeed very strong demand for loans across the investor types, a single B-rated issuer would rarely be able to price their loan with a margin below 400 basis points. So this investor composition is not likely to meaningfully shift in the short to medium term. And with European loans explicitly excluded from retail products in Europe, such as UCITS funds, the asset class should continue to benefit from the institutional ownership base that promotes the asset class's low volatility characteristics. And so that concludes our first section of the presentation, where we've outlined the size, liquidity, and what we think is a pretty compelling performance profile of the European leveraged loan market. So I'll now turn it over to Boris, who will take a closer look at the factors driving the attractive risk-adjusted return profile.
Thank you, Elliot, and thank you everyone for joining us today. And hope that you've had a wonderful summer and that you're going to find this interesting. But to continue on a lot of the themes that Elliot started us with, and looking at the drivers of the attractive risk-adjusted returns, we will start with what makes this strong and improving credit performance, and how that is driving into the performance of the overall asset class. So if we flip forward to page 16, one of the things that we would like to kick off and really highlight is that the asset class has consistently been showing low default rates, but what makes it a real differentiator from other parts of the portfolio that you might be looking at with the different asset classes are the very strong recovery rates that this asset class has gotten historically. So if you keep in mind that this is asymmetric risk, we invest in credit. So, you know, we lend out 100 cents or 100 pence, and we look to do everything that we can in order to get that money back, and make sure that we're making the best investments that we can and investing in the best companies that we can and the most defensive. We try to diversify portfolios, and that's what the leveraged loan market offers when you're looking at making the investment into this asset class. So you can see on the left-hand side of the chart, or on the left-hand side of the page, the chart that shows our default rates, and the European loans are currently sitting at a very low default rate, but have historically been running at lower default rates than most of its comparable asset classes. That's very important because in that event of default is really the one time that you can potentially experience an impairment. And when you try to recover the money that you've invested, you know, how much can you get back up? The 100 cents is what is of paramount importance. And those are some of the features that we will talk to as well. When you look versus the other asset class historically, particularly over the last 5 years, you can see that it's been less than 1% on average over the last 5 years in terms of defaults. But what is more important is that recovery rate. If you look on the right-hand chart, European loans rank senior in the capital structure. They are predominantly first lien instruments so that they sit as close to the assets as possible, which we'll show in a moment as well. And the current recovery rates on European leveraged loans is much higher than comparable asset classes, running at around 84%. So that means that when there is this default, the average recovery rate is a little over 84 cents. And when you look over the last 5 years, it's around 67 cents, which far outperforms the other asset classes that we see on the page, including US loans and European and US high yield. The high yield markets are predominantly unsecured piece of paper, and that is why the recovery rates tend to run lower than in the loan market. So that's a very important feature when you're looking to make this investment, because you're getting yield, but then there is also a strong recovery in the event of a default, which is running at a very low rate. But Elliot touched a little bit on liquidity, on scale of the market. And if we flip forward to page 17, you can see that there is a very large opportunity set that still presents itself for us as investors. And when we think about who are the primary users of leveraged loans, it's not just corporations, but a lot of private equity firms tap into this market to execute on their transactions and finance acquisitions that they are making. And they currently have a very large pool of capital. As you can see, it's getting close to $1 trillion, at north of $800 billion. If you think that that is typically almost half of a capital structure, that means that those assets need to go and find about another 800 to 900 billion of borrowing in order to execute on their plans in order to invest those funds and get the returns that they're promising to their investors as well. So they need to be good stewards of that capital. They don't want to over lever businesses, but they do want to get an attractive deal done so that they can leverage that pool of assets and create the returns they need. And that's a big opportunity set then for us, because away from just private equity use, but also regular corporate uses, that means that the opportunity set should be north of $1 trillion, which allows us to be very selective in terms of portfolio construction. But on the right-hand side, what you also seen in this evolution is the growing size of the transactions themselves. And why is that important? It again allows for that portfolio construction to be more dynamic. It allows for us to tap the market for liquidity. It allows us to trade the loans and therefore make it a more robust and defensive marketplace, because if you can move in and out of the asset classes with comfort, as you would know from investing in equities or investment grade bonds as an example, then it allows you to be nimble and a little bit more reactive. And this has been a huge improvement, even when you look back over the last 10 years, and you can see that the average size loan has gone from around 200 million euros and more than tripled in size to today. So that gives us an opportunity to be more dynamic in our portfolio construction and make a better investment case for this asset class. But again, going back to some of the basics that we've talked about, if we move forward to slide 18, I mentioned earlier that this is a first lien piece of paper. And the reason that is important is that you can see in terms of where you sit in the capital structure and what you can recover from a debt instrument is critical. So in terms of priority of payments, when you look at the capital structure, you do in certain situations have a piece of paper that might sit slightly ahead of you, but generally speaking, first lien is the first priority. So you have a claim, or you have the first claim in a default scenario over the assets of the borrower. And that is why you have the very high recovery rates within this asset class, is because of that first secured piece of paper and that first secured priority of payment within the waterfall. And so that's a very important feature of the market. And as you can see on the chart on the right-hand side, when you look at European loans, even versus the US market, but then European high yield and US high yield, 99% of the market is first lien. So when you're looking at these, when you're looking at this asset class, and there's over 550 issuers that you can choose from. Around 99% of them are going to be first lien in nature, with a very small proportion of second lien within the market, and then no unsecured paper. So it's an extremely important feature of this market. But also, if we look at page 19, when we think about the way that it's changed, and what kind of diversity we can acquire. As I mentioned, there's over 550 deals that we can take a look at in order to select within this universe. But more importantly is that the industry breakdown, it's over 20 different industries, so different different and distinct industry profiles that you want to make sure that you're covering very carefully. But we do like the defensive nature in particular of a lot of the industries, and you can see that that's actually been improving over time, and since 2010 has improved dramatically toward the more defensive end of the sectors. So like as an example, the biggest sector exposures we have in the European loan market is within healthcare, and then media and telecommunications, services, information technology. These are defensive, resilient industries that are they're long time tested, and so they're actually very attractive from a credit investment perspective, because they tend to not exhibit as much volatility as some of the other sectors. They're more predictable. They're a little bit more consistent in terms of doing the credit analysis and making the investments. And as I mentioned in the previous slide, you're investing in a yield product that is sitting as close to the assets as possible within these categories or within the capital structure. So you're looking at defensive sectors, or a largely defensive construct of industries within this asset class. And then you're investing as close to the assets as you can for that additional security. And so that, this is another element that makes it a very attractive place to invest. But if we move forward to page 20, or to slide 20, we also like that there's diversity across geographies. So while it is predominantly European facing, there is a little bit of outside of Europe in terms of global companies that come and invest. But you can see that there is a fair amount of diversity in terms of geographic exposure within the asset class. And on top of this, when we think, it's not necessarily, I would say, off benchmark, but if we think about overlap, or we think about other ways to diversify a portfolio, you can see on the right-hand side that if one invests in equities, or if one is investing in high yield, as an example, the amount of overlap with European loan issuers is actually not as large as one might consider. When you see that European equities, there's only 9 European equity issuers, or 9 public companies that overlap with the European loan market, and about 60 high yield bond issuers. These overlaps are much bigger in other markets like in the US, but here it really does present an opportunity to diversify a portfolio and move some of the correlation away when you're looking at these other asset classes as well. But last and more importantly, if we move forward to slide 21, and we were discussing this a little bit earlier, we talk about the defensive sector composition within the European leveraged loan market. And so on slide 21, if we can roll forward, please, you can see that around 80% of the European loan market in terms of value has relatively low levels of volatility versus the more volatile and more cyclical ends of the spectrum that we see to the right-hand side of the market. So when we're thinking about portfolio composition, and we're thinking about just the market or the asset class as a whole, around 80% of it is actually relatively low in terms of volatility, and presents a very attractive opportunity set, because as Elliot mentioned in one of the previous slides, when you look at the drawdown dynamics of this market versus the other asset classes, when you do find periods of stress, you're not going to have as much mark-to-market volatility. There's not going to be as much pain seen in this portfolio versus other portfolios. But more importantly, because they are defensive sectors, and because of that composition that we were discussing before, your ability to get the capital back, or to get back to the 100 cents, is actually far greater than a lot of the other asset classes that we look at. So this from a holding perspective is certainly an attractive feature as well. But that defensive sector composition is a very important characteristic from a long-term perspective, and it feeds into the lower defaults and it feeds into the recoveries that we were talking about earlier. And so that that is something that we do like to highlight, and we do really like about the asset class. So I think I've been rambling enough, and at this point, when we look forward to the rate structure of the asset class, I'm going to hand this over to Brian to continue on the themes. Thank you.
Thank you, Boris, and welcome to everybody. We are going to spend just a few minutes on the interest rate considerations, because loans are, of course, a floating rate asset class or variable rate in nature, with the coupons paid quarterly, but also resetting quarterly based on 3-month Euribor, whether it has gone up or down. But just considering them variable rate or floating rate in nature does miss out an important part of European leverage loans, an important protective measure, so to speak, that is built into the loan documentation, and that is the Euribor floor. Because nearly every loan in the European market has a lower bound for Euribor written into the documentation of at least 0, or in some cases higher than 0. And this has been a very important and beneficial factor in the market over the last several years, when Euribor has, of course, been negative. It's essentially provided a boost to the spread and to the coupon to protect investors. And the value of that benefit obviously has varied with time, depending on how negative the 3-month Euribor has been. Euribor floors continue to be written into every new deal that comes to the market. And now that rates are increasing again, with 3-month Euribor at around 75 basis points as of today, we'll start to see the floors in new loans being reset higher. So the floors in the documentation will rise as rates rise to reset the level of protection for investors at a higher level, so that at some point in the future, when rates do begin to fall again, loans will have built-in protection against falling rates. So the Euribor floor in loans protects the investor's coupon basically against a reduction in interest rate, despite them being variable rate instruments. So on the next slide, 24, we have to think about rising rates as well, because obviously we're in a rising rate environment. Loans in this environment, quite frankly, are the largest beneficiary asset class in liquid credit. As returns so far this year demonstrate, the duration that comes with being a fixed coupon asset class, such as high yield or investment grade or government bonds, have hurt returns. While the coupon collected on loan investments has increased as rates have increased. Duration, as we can see on the chart on the bottom, has more than doubled the loss of every fixed rate asset class so far year to date. So a very good demonstration of why you want to be in a floating rate product, such as loans as interest rates rise, but also a reminder that European loans have Euribor floors, which protect the downside when interest rates eventually fall. On the next section, starting on slide 26, I'm briefly going to touch upon a couple of additional aspects of the loan asset class where there have been evolution, I guess is one way to put it, over recent years. And the first being covenants. 10 years ago, all loans had maintenance covenants. Covenants which must be maintained, cannot be broken, or else you have the possibility of default. And these were things like leverage must not increase above 5 times, or interest cover must remain above 3 times, etc. Today, maintenance covenants are all almost non-existent within the loan market. We call loans with no maintenance covenants covenant light. This does not, of course, mean that they are covenant free. Loans do have covenants. It's just that rather than maintenance covenants today, loans have incurrence covenants, which of course are the same type of covenants that you find within high yield bonds. Intuitively, maintenance covenants seem better for investors because they seem like they're stricter. But this obviously is not always true. During COVID, for example, which is a great example of this, if all loans had maintenance covenants, we would have likely had a very large default wave on our hands over the 2 years in which industries weren't able to operate. Very good businesses, which have completely recovered by now, would have defaulted, handed the keys over to new owners, and investors who invest in loans and couldn't take part in restructurings would have been forced to sell at the lows in many cases. There would have been a lot of unnecessary investor losses. And management teams of these companies obviously would have had to spend management time asking for covenant waivers, renegotiating terms during a time of great uncertainty. And a lot of the companies who needed emergency financing would have found it very hard to get this sort of funding while they were in breach of a maintenance covenant. So once again, there would have been a lot of investor losses. So while the entirety of the loan market has recovered from COVID already, more or less, it would have been a very different outcome if maintenance covenants would have been in place. So incurrence covenants, or covenant light, as we call it in the loan market, is working for the loan market as it's working in high yield. On the next slide, we take a look at another very important evolution in the market, and that is the attractiveness of the asset class for investors who are mindful of sustainable investing. Starting with the carbon footprint of the loan universe, there are almost no energy credits to be invested in within European leveraged loans. The energy sector comprises less than 0.5% of the index overall. The transportation sector, which is another high carbon footprint sector, is less than 3% of the index. And on the other end of the spectrum, sectors which have very low carbon footprints, telecoms, technology, large parts of the services sector, make up around 35% of the index in aggregate. So the starting point of investing in European leveraged loans is certainly more environmentally friendly than some other asset classes. From there, though, it gets even a bit more interesting because European leveraged loans are at the forefront of including what have become known as ESG ratchets in the loan deals that come to market. These ratchets will either increase or decrease the coupons of the loan deal depending on pre-agreed ESG targets. There is a financial incentive then, either a carrot or a stick in most cases, for companies in the market to improve their ESG outcomes. And the coupon adjustments in the market at the moment range from anywhere 2.5 basis points, all the way up to 20 if there happen to be several ESG KPIs that the company is trying to meet. And these KPIs are tailored to each individual company that comes to market. So for a pharma company, it might be providing a certain amount of free or low-cost medicine to underserved communities, or for a food manufacturer, they might be required to get its suppliers to adopt best practices in terms of animal welfare or low water usage farming, these sorts of things. And obviously for any company coming to market, they could have KPIs around the reduction of greenhouse gases, or improving labor conditions for their workers, or increasing the diversity of their leadership team, these sorts of things. And in many cases, the money that the issuer may save in interest payments, should they meet their targets, must then be reinvested again into further ESG initiatives. So even meeting the targets is not the final extent of the improvement that a company will have to make over time. So an important byproduct of this, if you think about it, is that these ratchets increase the frequency that a company collects this ESG data, and the frequency at which they're required to report it to the market. So ESG disclosure and transparency in the market is constantly improving, along with company behavior. So, and this is with financial incentives in place, by the way. to make sure that this continues. And the European market is really leading the way here. As you can see from the graph, how quickly these ratchets are gaining traction within the European leveraged loan market. So with that, it brings us to slide 28, which is really the end of our prepared remarks. We hope that this has been a useful overview for you of the asset class and maybe convinced you that European leveraged loans should be a core part of any diversified pool of credit investments, which is something that Elliot mentioned earlier. The numbers certainly tell a compelling story. It's a very large and liquid asset class with an attractive return profile, relatively low volatility, and hence the best Sharpe ratio that you'll find within liquid credit. It comes with rates protection in both directions and is really leading the way in adopting specific measurable ESG KPIs and holding the issuing companies to financial account for these targets. As Elliot mentioned earlier, the genesis of this presentation was a more detailed white paper, which we published on the topic recently. You can find that on the Ares website if you like, and if not, there is a contact page at the back of the presentation which will be made available. Feel free to reach out to anyone there at any time. And with that, we do have a few minutes left, I believe, so we can open it up in case there are any questions.
Thank you very much, Brian. Thank you, Boris and Elliot. Regarding the paper, you can also find it on our website, so feel free to download and study the paper. And thank you very much again for this very interesting webinar. I received quite a few questions, so let's dive directly into the Q&A session. First of all, looking at the market in the last 8 months, do you have any sense on how liquidity has been shifted over the course of the recent of the past months? And can you share maybe any stats in terms of trading spreads, levels, and volume?
Yeah, sure. Why don't I take that one? When it comes to market volatility, which we have had a lot of this year, you do often find that the liquidity of all credit asset classes can slow down over time. And of course, the European leveraged loan market is not immune to that. But that being said, the liquidity within loans has vastly improved over recent years, as Elliot showed earlier. As the size of the asset class, the number of market participants, and the size of the individual loan tranches have increased, the liquidity within the market has increased. So we, for example, have had not much problem at all turning over our portfolios when and where we want to within the market. You usually always have a bid and an offer on any particular loan tranche, unless it happens to be, a very small loan, which you probably knew from the time they issued it that it was going to be illiquid, which you find those in all asset classes as well. I think in decent conditions, bid-offer spreads are usually about 50 basis points. In volatile times, they probably widen out to about 100 basis points. But the liquidity within European loans, I would say, is no different than what we find in the high-yield market.
Yeah, thanks, Brian. Next question. Regarding financing asset-light companies, e.g. tech companies, what collateral are you using for your loans? As being close to the asset with being senior in the capital structure does not help much in terms of the recovery rate, isn't it?
I can start with that, and I think it's a very valid question. In today's world, there's a lot of value placed on intangibles, right? So you have a lot of value that's placed on the intellectual property. Technology companies are typically actually very good credits from the perspective that they have. So we like to invest in the companies that have, subscriptions as a service, like SaaS type of businesses, because there's a very predictable recurring nature to the revenue streams within those businesses, and the intellectual property of that business is where all the value is created. So yes, you're not physically leaning on machinery or manufacturing processes, but your lean is against the intellectual property, which can be highly valued and highly recyclable, something that you can salvage and sell in the situation that you need to. But the contractual nature of those revenue streams and the predictability is what makes those companies very attractive lending candidates.
Thanks, Boris. So maybe you talked a lot about the primary markets. Maybe you can give us any insights of the asset class in the secondary market. So there's the question: are you expecting to see papers coming out at very attractive terms in the primary market, and is this affecting the price or bringing the price down in the secondary market?
Yeah, maybe I'll take that one. So the average price of loans right now in the secondary market is low 90s, so around 93 as of today. So there's already a large amount of convexity within the secondary markets, which makes it fairly attractive. Now, yes, the answer to your question is yes. When primary deals are going to start coming to the market, hopefully this week, they're going to have to offer a discount to investors enable to motivate them to participate, because at this point I can buy very attractive loans in the market already at a price of 93, at a spread of 600. So to participate in a new deal, I'm going to need some sort of new issue discount. In many cases, that is a great source of future returns for us and for other loan investors, because very good company who may need to raise financing for some M&A will have to come to the market and issue at a discount in order to get us to participate. And obviously over time, that discount will accrue to us as investors. In terms of whether or not it has effect on secondary levels, it certainly can. If a new issue loan comes to market, which is a very good comp to something that's already trading within the market. But to be completely honest, that happens more in high yield, I would say, than in leveraged loans. Leveraged loan investors, especially in Europe, tend to be a little more sticky in what they own. They don't necessarily want to trade out of one particular company just to pick up a few bips by buying a similar company in the primary market. They tend to be a little bit more buy and hold in nature. So the effect that a primary deal will have on secondary levels tends to be a little bit less volatile than what you'll find in the high yield market.
Okay, thanks, Brian. The next question is pretty specific about slide 11. Comparing calendar year 2020, 2022, there are quite some significant gaps between European loans and US loans, and in 2020 there's quite a significant gap between European loan and investment grade performance. So is there any reason for that? Can you maybe explain why there's such a significant gap between the performances?
Maybe I can just kick off with a few comments on that. So I think what really helped the investment grade markets in 2020 was the fact that investment grade markets have a much higher sensitivity to interest rates. They have a much higher duration. And so one thing that happened pretty quickly after the drawdown was that rates went lower. And that would have helped the total returns of the investment grade asset classes more so than loans and high yields, which have a much lower duration profile. And I think the other sort of obvious thing to say as well is that they are investment grade. So whereas I think there was probably more concerns over the creditworthiness of the loan and high yield assets, asset classes. There was less concern that, you know, large investment grade names such as Apple and Amazon were going to go anywhere anytime soon, despite the fact that they were entering the pandemic.
And Elliot, maybe you can continue. How high is the correlation in average between the markets?
The correlations can be relatively high, depending on where you are in the market, you know, and depending on what market conditions are. So, you know, certainly when we've seen very easy monetary policy, as been the case in recent years, the correlations have been relatively high. However, once you do see more volatility, that's when correlations will come much lower. So, for normal market conditions, they can be sort of just over 50%, 60%, but these can go, as I said, much lower as volatility picks up.
Thanks, Elliot. I think, Brian, it was you talking about rising interest rates. So there's a question, impact of increasing interest rates. What important changes would you see? Do you expect default rates to go up in the coming months?
So I think maybe not in the coming months, but certainly in 2023, we are expecting higher default rates, both for leveraged loans and high yield, but only going back towards more normalized levels, because if you think about default rates today, they're very near zero, because corporates have put themselves on very sure footing with very strong balance sheets, very high cash balances, and they've turned out their debt at very low levels. So while we do expect an increase in default rates, we don't expect the sort of double-digit default rates that you might see under a normal recessionary environment this time around. We think the default cycle could be a little bit more mild. And if the question was specifically pointing towards the rise in interest rates, we have done pretty detailed work on interest cover within the asset class, within leveraged loans. If you exclude the companies that were hit hardest by the pandemic, interest cover is quite high in the mid to high single digits. So we don't think that the interest rate rises which we've seen and which we expect to see over the next few months will be enough to push many companies into default or severely limit their ability to pay their interest payments.
Thanks, Brian. Just let me screen the questions. So maybe one last question. You talked a lot about, or you compared a lot the US market to the European market. Maybe you can show us the differences between those two markets, and has the performance been similar or not, maybe? And last but not least, if you like to, please give us an outlook on the European CLOs.
Well, maybe I can kick off with a comparison between European loans and US loans. I guess maybe starting with the size of the market. So as we mentioned at the top, European loans are about 400 billion euros in size. I would say US loans are about sort of 3 times that. However, if you look at the growth over the past 5 to 10 years, the growth in European loans has been higher versus US. So for example, I think US loan market grew about 50% over the past 5 years, whereas European loans has actually doubled in size. There are a lot of similarities. So the seniority, which Boris went through earlier in the presentation. So both markets are predominantly first lien instruments, so call it 97%. And from a rating and sector standpoint, they are also fairly similar. They're predominantly single B assets, and there's a large weight into defensive sectors such as healthcare and technology. The one thing I would note, though, is that US loans does have a larger bucket to triple C assets, so sort of 10% as opposed to 5% within Europe. And then also it does have a slightly higher allocation to some cyclical sectors such as energy. albeit a small sort of, call it 3 to 5% as opposed to less than 1% in Europe. I guess two key differences to point out. One is that European leverage loans, the deal flow that you see come through is far more associated with private equity sponsors. So call it sort of more than 70%, whereas less than, call it around 50% of US loan issuance tends to be associated with private equity. And then I think the final key difference to point out is, we talked about that ownership composition within European loans as being 99% or pretty much 100% institutional in ownership. Within the US, it's a slightly different dynamic. So around 15% of that market we estimate to be owned by retail funds. And so the US loan market can be subject to those technical pressures that are associated with retail outflows as and when market volatility picks up. And then I guess finally, just in performance, you probably saw throughout the deck that both have low volatility characteristics. They certainly are similar from that perspective. But if you were to look at both markets side by side on a calendar year basis, if we look back over the past 15 calendar years, European loans has outperformed 11 of those 15 times. So, so yeah, we would certainly say a slightly better segment of the market from our perspective. Not sure if Boris, Brian, have anything to add to that.
I was going to say I can pick up a little bit on the CLO space, and the current pipeline is still reasonable. There's still quite a few warehouses out there in the European loan space that are looking to price CLOs. And from what we understand from banks, there's not a lot of utilization under the warehouses. So there's not too much pressure on managers to come to the market. And the liability side of the capital structure is still a little bit elevated. But I think one thing to keep in mind is that it doesn't necessarily matter how much the liability side costs, as long as the arbitrage works and you can get the assets, you can get the collateral or the loans in this particular situation at a price that creates that arbitrage, or so at a yield that creates the arbitrage that works for the CLOs. So we are seeing some come to market when those moments occur. And I think that there is an expectation that the market should be opening up a little bit, because we've seen pricing on the liability side about as wide as it could get in the summer. I think nerves are starting to calm. People are getting their heads around where the direction of travel is for the asset class. And as a result, investors are starting to show back up. It's more active in the US. I mean, we've seen a lot of CLO activity and CLO formation still happening, every week in the US, but it's just been slower in Europe, and we think that that'll change between now and the end of the year.
Thank you very much, Boris. So I don't see any more questions. So of course, feel free to contact Boris, Elliot, and Brian after the webinar. My colleague Roland will send you the contact details as well as the presentation slides. So perfect timing, 12 p.m. Once again, thank you very much for this really interesting webinar. Also special thanks to Daniela Johnson for bringing us together. I wish you all the very best. To the audience, hope to see you pretty soon in Frankfurt or on Wednesday in the next BAI webinar. Thank you.
Thank you.